Hello and welcome to today's webcast presentation where we have ViaCon presenting. With us today we have the CEO Stefan Nordström and CFO Philip Delborn. If you have any questions for Stefan and Philip, you can use the form that is located to the right, and we'll take that up during the Q&A after the presentation. And with that said, I'll hand over the word to you guys. Please go ahead with your presentation.
Thank you very much. Here is Stefan Nordström, the CEO of ViaCon. We will cover in this report Q2 in brief and the market development. I will share that. And then Philip will cover the financials from Q2. And then I will come back towards the end talking about our intensified efficiency work. And then we'll round this off with the Q&A as stated. So if we look at Q2 in brief, the interest rate increases coming from the high inflation throughout the first half of this year have caused delays in our customers' financing solutions for infrastructure projects. And this has caused delays in many of our customers, also existing projects. And thereby this has impacted our sales and our results negatively in the quarter. But the demand for our solutions is still high, and the order intake during the second quarter amounted to 53 million euros. However, this means an organic growth of minus 10% compared to the same period last year. However, during the summer months this year, we have had a clearly increasing order intake and enjoyed quite a good comeback rate of the market and orders. Our cash flow from the operating activities improved by 5.5 million euros compared to the quarter before. And this is mainly due to the working capital efficiency work that we are constantly running in the company. And due to the delays in customers' projects, we proactively decided in June to intensify our efficiency work that we initiated at the end of 2022. This was also communicated through a specific press release at June 21 this summer. And that press release talked about us reducing the workforce by approximately 180 positions. And we do now expect this initiative to give us sustainable efficiencies corresponding to around 10 million euros on an annual basis. If we look a little bit at the market and the outlook of the market, again, the high inflation and the following interest rate rises create delays in customers' financing solutions for different infrastructure projects around in Europe. And this may continue to cause postponements or delays of new and existing customer projects. However, the overall demand on the infrastructure market in Europe is still there and is expected to grow this year and also beyond. But with continued challenges in financing of new and existing projects, this may cause some short-term further delays. So more volatility and that we need to prepare for, and I'll come back to that at the end of this presentation. The availability and pricing of the raw materials and other components that we buy has clearly stabilized and continued to stabilize into Q2 of this year. We also have efficiency activities underway to gradually compensate and offset the other realized inflationary pressures. But in the orders that we take, we continue to see that we are gaining market shares from competing solutions. And of course, our sustainable solutions give us a clear competitive advantage in this situation. So with that brief introduction, I hand over to you, Philip.
Thank you, Stefan. If we start by looking at the group numbers for the second quarter, we had an organic growth in sales in Q2 of -14.3%. The total decline was 18% in the quarter. And as Stefan mentioned, the increased interest rates and the high inflation during the first half of the year is really impacting our numbers. And it's linked to the customers' more challenging situation for finding financing solutions for their infrastructure projects. And this impacts both our top line and our EBITDA, as you can see from these numbers. If we look at the order intake in the second quarter on a group level, we are at 53 million, which is approximately 10 million higher than we had in the first quarter, but it's below the second quarter of last year. And then if we dig into the three business units, and we start with bridges and culverts, here we can see the impact from the challenges that our customer has in their financing solutions, as well similar to what we saw on the group level. In the quarter, we had an organic growth of -21%, and the lower intake that we noticed during the first quarter is now impacting the sales in the second quarter. And if we then look more specifically to the order intake in the second quarter of this year, we could clearly see this increase in order intake during the summer months. And when I say summer months, I mean the full summer month, not only the month included in the second quarter. So we ended up in bridges and culvert solutions of an EBITDA of 1.2 million compared to 4.6 million the same period last year. And then if we move over to geotechnical solutions, we have a similar pattern as in bridges and culverts. The organic growth was -19.7% in the second quarter. And the reason is very much the same as we saw in bridges and culverts business unit. We continue to work with focusing on high margin products and leaving the low margin products, which over time will help us increase our margins in this business unit. And if we look at the quarterly EBITDA, it's of course impacted by the lower sales in the quarter as well. The order intake was below last year's second quarter, and we saw an improvement during the second half of the quarter. So the main impact of the lower intake came from the first half of Q2. Then the third business unit, stormwater solution. Here we can see a different pattern. We actually had quite strong growth, both in sales and EBITDA in the second quarter. The organic growth was 8.7% in this business unit, and year to date we're at 9.5% organic growth in stormwater solutions. And this growth, in combination with the efficiency work that we're working on in our production facilities, improved the EBITDA quite significantly in the second quarter. So that's really good. If we look at the order intake, it's below last year, but that is mainly due to the phasing of some of the larger projects that we have in our pipeline and that we had last year as well. If we then look at the cash flow and our financial position on group level, as Stefan mentioned, our cash flow improved in the quarter. We had a cash flow from operating activities of -2.4 million compared to -8 million the corresponding period last year. And the main driver here is the positive effect from the change in working capital. It improved from -4 million. It ended up at -4 million, which is an improvement from -12.9 million the same period last year. It's actually all the parts of the working capital that is moving in the right direction in cash flow terms, like inventory, receivables, and so forth. So that work is really showing up in the numbers as well. When it comes to the CapEx, it's slightly below last year. We invested 0.7 million during the quarter compared to 1.2 million the same period last year. And in terms of our financial position, we've decreased our net debt during the quarter compared to last year. We are at 106 million now, and if we exclude the lease liabilities, we are on 96 million compared to 101 million same period last year. And the cash and cash equivalents amounted to 15 million, which is also an improvement compared to last year. And on top of that, we have an undrawn revolving credit facility of 5 million, which is the same level as we had a year ago. Our total equity end of the period was minus 2.4 million compared to minus 0.5 the year before. So that was the numbers in a nutshell.
Thank you, Philip. Then I will share some more facts on the intensified efficiency work that we run in ViaCon. So in June of this year, we decided to intensify the efficiency work that we actually initiated already at the end of 2022. And the aim here is to further slim our organization, to increase agility and efficiency throughout the group. We still see, as I said earlier, an active and growing market demand, but the higher inflation and interest rate rises create this continued volatility and delays in customers' financing solutions for infrastructure projects. And this goes for both new projects and for also existing projects, but to a little bit of a smaller degree. So we will reduce our workforce by approximately 180 positions, and that's what we said at June 21. As of today, the majority of these 180 positions have been identified, and the corresponding employees have either left the company or will within short leave it. And selected parts of our group are working on identifying the remaining part. So through this initiative, we are planning to reduce our costs and excluding non-recurring items compared to the plans we had for costs in 2023 by approximately 5 to 6 million euros for the full year. And this will then result in sustainable efficiencies corresponding to around 10 million euros on an annual basis. So this work, combined with the increased order intake during the summer months of this year, means that we look forward to a continued good development of the ViaCon Group, both short and long term. And the efficiency work will, of course, also strengthen our ability to better manage any continued volatility on the markets in the near term. So this, we feel, are absolutely the right actions to have taken and taken proactively starting in June. So this was more the factual input on this call. Now we open up for any Q&A.
Thank you very much for that presentation. And like I said, now we'll jump into the Q&A section. And we'll start with the first question here. Expected efficiencies of 10 million euros on annual basis is all related personnel cost?
No, it's not only personnel cost. It's also other external costs that we have, consultancies, other services that we buy outside, but the majority is personnel related.
Okay, and was a quarter-on-quarter increase in personnel costs due to the NRI in relation to layoffs?
To some extent, yes, but we've also seen quite strong inflation compared to a year ago in many of the markets. We have a quite large footprint in some geographies where inflation has been quite significant the past year. So that is also a factor. But we have some of the non-recurring items, of course, included in the personnel cost also in the second quarter.
Okay, and will the remaining NRI related to layoffs be evenly distributed between Q3 and Q4? And will it be charged the personnel cost line in the P&L?
On the first question, if it will be evenly distributed, I would say probably be a bit more in the third quarter compared to the fourth quarter, because we're, as Stefan mentioned, now finalizing the final steps in terms of reducing personnel during this quarter, and some effect will also, of course, come in the fourth quarter. And in terms of non-recurring items, the majority is linked to redundancy cost and personnel cost, and will be shown on that line in the P&L, yes.
Do you foresee a sequential improvement in turnover and profitability, or how should we interpret the increasing order intake during the summer months?
We do expect a stronger second half of 2023 than the first half, given the order intake combined with the cost reductions. This is our expectations.
Okay, and given your announced efficiency measures, how should we think around the future growth looking at 2024 and beyond that?
As I said, we still expect a growing demand of the infrastructure markets around in Europe. There is still a lot of new roads and railways that needs to be built. There is a very high need for refurbishment of infrastructure in mostly Western Europe. So there is a long-term plan fully supported by EU funds and by national funds as well. So we can expect the demand still to be there. But as I said, with the short-term challenges on interest rates coming from the higher inflation, we can expect some shorter-term volatility due to delays of existing projects or certain postponements of new customer projects. So sort of a still positive derivate on the growth of the demand, but a higher volatility around that average growth value. So we are still planning for a growing business going forward.
Okay, and what has the response been like from your customers during the quarter? Are they satisfied, or has there been any other feedback?
We did a little study among our customers, selected group of customers around in Europe towards the end of June, and we received very positive feedback on the way we service them, the way we support them, and our abilities to adapt to their changing needs. We did a couple of years ago a major study among many customers around in Europe, and we had the same very strong positive feedback from a large group of customers. So we're highly respected on the market from customers, from infrastructure authorities and faculties working with civil engineering, supporting infrastructure authorities around in Europe.
Given the current economic climate, how does ViaCon prepare in order to deliver results in the coming quarters?
By increasing the efficiency in the company, reducing the workforce means that we need to find, and we are finding, new and more effective ways of working together. This not only reduces the cost in itself, but also increases the speed of response and agility throughout the organization. So these are absolutely the right measures to take, not only for the short term, but also for the longer term in the company. And as stated by me earlier, this work was actually already initiated at the end of 2022. But given the higher volatility in the first half of this year, we decided to intensify this work and run it in a shorter time frame.
You're mentioning that you're increasing your market share. Would you say that this is in line with your expectations?
Definitely.
Okay. And what challenges do you foresee looking into 2024?
A continued short-term volatility on the markets coming from these financing situations, as both Philip and myself have mentioned now. This will be the major challenge. But we are ready for it. We had it already during 2022, and on a larger scale or on the more full year effects of this in 2023. Last year, the effect was more there from Q2 and to the end of the year, when inflation really started to hit markets all over, regardless of what business you talk about. So we are ready for it. Now we know what a full year of volatility means. So that's our main challenge, but we're ready to deal with it now. I also want to add, please, that with the strong customer relations we have, we often also have the ability to discuss, possibilities to still do shipments to our customers and manage flexibility on both sides of the fence, both on our behalf, and on our customers' behalf.
And can you comment on your infrastructure projects in Europe?
Yeah, in general, there is an increasing demand. As I said, there are still a lot of infrastructure that needs to be established, more into former Eastern European countries, but in the Western world or Western Europe or former Western European countries, the demand for refurbishing existing infrastructure is very, very high. And we are very, very well positioned to service our customers, both when it comes to new infrastructure projects, but also when it comes to refurbishment solutions. On top of this, the environmental concern is steadily increasing with our customers. And we notice this in our discussions with all our customers, that we are extremely well positioned with a very strong sustainability offering compared to the alternative materials, which is mostly made in concrete or in plastics.
I would take one final question here. What can investors expect from ViaCon in the remainder of 2023?
A stronger second half, we expect, compared to the first half. An increasing lower cost than what was planned for this year, and well positioned for a good development, given the tougher circumstances also for 2023, but also well positioned for dealing with this volatility in 2024. We don't know if it will continue for the full year of 2024, but we are planning for it. So we are ready to deal with that, and we are much better positioned than what we were getting into 2023.
Okay, thank you very much, Stefan and Philip, for presenting today and answering all of our questions. And also a big thanks to all of the viewers who followed along ViaCon's presentation today. And I hope you have a great rest of the day. And until next time, thank you very much and goodbye.